Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. My co-hosts are Brendan Walsh and John Fagan of Markets Policy Partners. John Dick, CEO of Civic Science, is also here for our holiday edition of the Macrocast. Hey, guys.
Hey, happy holidays.
Happy holidays. Well, December is the gift that just keeps on giving. The latest data on inflation shows that prices actually dropped in November. They didn't just slow down, wasn't just slower growth. They actually fell by 0.1%. And this is the first decline in prices we've seen since April 2020. And this measure of inflation, the PCE price index, is the one that the Fed prefers to use. So John, Brendan, and John, despite the somewhat hawkish Fed talk we've heard in recent days, it seems like we might be at an inflection point in the data.
Yes, definitely. And even more importantly, the year-over-year numbers was 3.1% for core. But when you look at it at a 6-month annualized, we're now below the Fed's preferred target of 2%. It came in at 1.8%. So, when you look at the year-over-year number, a lot of that is stuff that happened a long time ago that gets put in the calculation. So the Fed's supposed to be forward-looking. So this number kind of gives them cover. And also, because this number is computed from the most of the numbers come from the CPI and the PPI, and then they just kind of weight them different. So at the meeting, the Fed had a pretty good indication what these numbers were going to be, which might have, it definitely played a role in their decision to kind of pivot and, give a 2024 outlook, which was, had a few more cuts in than the market was expecting.
Yeah, definitely. I mean, it seems like, this idea of higher for longer is, once again, longer is maybe not that long because the Fed could be looking at rate cuts as soon as the spring. If inflation is falling, then by holding steady, they're actually perhaps, pulling the reins too tight on the economy.
And I think that'll be kind of the story for 2024. The Fed said, we're going to cut 3 times, but they didn't tell us when. So, the market is kind of getting excited and a lot of people are expecting a March cut. But, there's a good chance that the Fed kind of stays a little higher for longer for the first half of the year and that the rate cuts come in the second half of the year. Obviously, a lot of that will do with growth and inflation, but the inflation numbers certainly seem to be heading in the right direction. We also have a few lagging indicators in that. The housing component is going to continue to be deflationary as the BLS data catches up with the real-time data. And used car prices, which played such a big role in the pandemic, went up. They've been coming off again. So those two will continue to kind of keep us in that 0.1 to 0.2% monthly inflation rises, which when you do the math is around 2% year-over-year inflation. I suppose the question is, how does growth hold up? We know that monetary policy works with a lag and rates are still pretty high. Do we start to see a slowdown in the economy, both businesses and consumers? And that's what we have John Dick for.
Hey, Brendan. It's like these are like such hot off the press numbers that the punditry hasn't like fully reacted yet. But is there a potential narrative here that this was maybe too steep of a change? Right? It seems to be, I wouldn't say shocking, but certainly surprising the extent to which it's fallen. Is there a chance? Is there any chance that this is interpreted as maybe too far, too fast?
Yeah, I don't think we're in the deflation camp yet, but certainly the narrative has completely changed from worrying about inflation to being it's back to normal, right, John?
Yeah.
Yeah. And it shows you that, the market reaction to these numbers essentially was kind of a yawn, which shows you just how priced for perfection markets have been. You can give them an astoundingly good, Goldilocks and not lower inflation, resilient growth, and all that is in these numbers today, looking at the...
But part of that, John, it was like I said, we knew what this number was. The risk to the market was that the calculation was wrong and it came in high. When you do the calculation, what 87% of the numbers are. So it's kind of a yawn when this number actually finally comes out.
Yeah, and the elements that were, the sort of curveball was the durable goods order, which were huge. It was a huge rebound. And, the market is still very much focused on, there was a little bit of a reaction. but the market has reverted immediately back to, expectations, the prevailing trends. Drift, the big move in yields seems to have passed, but, yields continue to drift lower. Equities remain supported despite some, pretty adverse commentary from Nike in its results yesterday. And and overnight, the Chinese putting some proposed regulations on spending in video games, which is denting the video games. But, the market is still very much focused on a soft landing scenario in 2024. And there's really nothing in this data that's going to dissuade them.
John and Brendan, I'm wondering, too, how much we might be able to benefit from baseline effects, right? The inflation spiked so much in 2020. I mean, this was the first drop since the pandemic. We saw some huge increases during those years. And I wonder, to what extent this is also just, there's not that much more to grow. Yeah,
and you're also right. The inflation numbers that are in the yearly calculation, the ones from January, February, March of last year are higher, and we're going to lose those. So also to John Dick's point, just the math behind it, we do start to fall off a cliff as long as we stay at a normal monthly increase. The year-over-year calculation comes down pretty dramatically. And that's, like I said, without even factoring in potential, very low shelter components for the CPI and the PCE.
And inflation came down in the month of November while consumer spending increased. And so it seems like there's still a pretty good news story for the average consumer and for holiday shopping, John Dick.
Yeah, today it's been it's I guess resilient is one way of putting it. Maybe the skeptic would say irresponsible in some ways. I mean, the amount of credit card debt that's piling up, particularly among like Gen Z and younger millennial consumers, is pretty astonishing. We talked in the summer about when I was with you about what the return of student loan payments was going to do to the consumer. It has not mattered. In fact, if you look at the consumers who report spending more on a holiday gifts this year, it over indexes among people with student loans, which, there's a potentially terrifying eventual reckoning around that could be coming, again, primarily for that sort of younger consumer. There's lots of theories about, this is a generation that's never been through an economic headwind before, and maybe just think that there's some sort of, savior coming down the road that will just kind of pay off their bills for them. I don't know, but I'll say a few things. Holiday retail is going to be strong. We estimate probably somewhere between up about 4.5% over last year, which is better than I think most people were estimating in the summer. We are worried about some consumer categories, at least in the first half of the year, as those credit card bills show up, and particularly for those younger consumers, which means categories like entertainment next year we expect to be soft. Apparel we expect to be soft. Narrower categories like quick service restaurants, fast food, first half of the year, where those people tend to be spending up are those places where where younger people tend to be spending in higher concentration. We expect those to get dinged a bit. But then other categories like home improvement, travel, we think will still be really strong next year. So it's going to be, again, just sort of a mixed consumer story. Another thing, like a big headline right now, is just the prolific use of buy now, pay later programs like Affirm among that younger group, again, which is just sort of kicking the can down the road a bit. Like when those things all come due in January and February, we'll see.
I actually have a question on that. Who is the consumer that uses buy now, pay later? What's the difference between buy now, pay later and just having a credit card? Have you already maxed out your credit card?
Yeah, there's definitely some of that. And it's generally kind of interest free, I think, right? Like it's more like a layaway program.
Oh, interesting.
Yeah. And look, like if you think about it, those platforms, I guess we'll call them, are kind of new technology, for lack of a better word. And early adopters of those things tend to be younger people, right? It's not 65-year-olds that, even like awareness of what Affirm or Afterpay is among 65-year-olds is super low. It's younger people that those things are marketed to and that use them, right? And so they're kicking that can down the road And, on one hand, if I'm a retailer, I don't want them to stop spending. If I'm an economist, I probably want them to slow down because, right, like at some point, too far is too far. And they're just kind of the term I hear, it's YOLO spending, right? You only live once. And so that's great unless you're 30 and you're going to live for 60 years, right?
Well, we're making some good medical breakthroughs. People,
I mean, you got to
live
a long time to pay.
Right now, they're all taking Ozempic, which means they're going to live longer and they're not going to have knee replacement surgeries and all the and chronic diseases. So yeah.
They can spend for their healthcare costs now, right? They don't have to pay it later. But, I think you bring up an interesting point. We had talked to someone earlier or in another episode of the podcast who said that it's actually kind of hard to get a read on holiday shopping now because of the rise of buy now, pay later. There's not good ways to track how much is being spent overall through those platforms. And so if you're just looking at the credit card data as a gauge of holiday shopping, you're missing a big piece of the pie. What do you think about that?
Well, I think that's true in the credit card category. But there are a lot of other, maybe not public resources out there, but companies like Circana, NPD-IRI, if you're familiar with them, that do a lot of like POS, point of sale tracking, in relative real time. We do have some visibility through our client relationships with retailers to get a decent read on what they're actually seeing at the cash register or on the website, right? So, which kind of helps. There might be elements of the sort of public market where some of that stuff is obscured, but it's not that difficult to piece it all together because we can also track like usage of those BNPL programs. Hence that sort of like 4 to 4.5% estimate that we have for the year. But yeah, I think there's reason to believe, and in some ways hope a little bit, that the consumer slows their spending a little bit in the first half of the year, just to kind of level set a bit. Again, particularly that younger consumer, but it's just going to be mixed, right? And maybe that's the wonders of our very diverse economy, right? Is that there are certain categories that will lift up the ones that don't do as well. The goods and experience kind of trade off that people make. So I don't see any reason to be pessimistic about the overall economy. I just think there'll be some softness in some categories that, companies in those spaces maybe need to worry about or adjust for.
Yeah. And I guess the upside of what you're saying in terms of the idea of YOLO spending or consumers feeling maybe confident enough to go out and spend money that they are hopeful will come through, that they'll be able to pay off later, is that a lot of this year, we had talked about this idea of the vibe session and the fact that even though the economy was resilient and strong and sort of forging ahead, that consumers didn't really believe that the economy was strong, that sentiment was lower than actually economic growth. It looked like from the numbers we've seen from the Conference Board and from Michigan that, sentiment was pretty strong in November. And I'm wondering to what degree that is holding steady through the month of December.
Well, we put our latest ESI reading came out Tuesday. It was down slightly over the last 2 weeks after what was a very healthy gain in November. Not enough to be alarmed. Maybe it was just also a little bit of a leveling off of sort of some extraordinary enthusiasm from the consumer in November. We won't discern a pattern from it until we see 2 or 3 downs in a row, because we'd seen 3 ups in a row through kind of late October through November. It's really hard, and I don't know if we've talked much about this before, but the consumer's perception of the economy is very different than it was 7, 8, 9 years ago. The consumer seems to have lost the ability to objectively evaluate their view of the economy. Part of that is just the nature of political tribalism, and we sort of like side with, I'm optimistic about the economy if my person is in the White House, and I'm pessimistic if somebody else is in the White House. The other thing is just that we're so glued to a 24/7 news cycle at this point, and economic news that's catastrophized tends to get more clicks than stuff that's positive, right? So the consumer's kind of view of the economy is somewhat manipulated by all of that. And what we've seen over the last year or two, and I think the Michigan and the Conference Board would also say the same thing, is that consumer confidence is not the same kind of leading indicator of spending behavior that it once was. It's just much more of a measure of the level of hope and fear people have about the political environment than it really is about their view of their personal financial position or the economy. And it's just made it harder for lots of economic norms that we used to rely on for forecasting and projections have been broken since 2020. And that's just another, that one started breaking in 2015, 16, but it's still a valuable read on the mindset of the consumer, but it isn't quite the predictive thing that it used to be.
That's super fascinating. I wonder, and hopefully I'm not putting you on the spot here, but I wonder, has there been any sort of research done around the results, right? So if the argument is that consumer sentiment is in large part related to political viewpoints, do we see that spending is different amongst Republicans or Democrats depending on what their view of the economy might be by political party?
The early returns on that is that yes, slightly, but not as dramatic as the disparity in economic views would suggest. There are, again, I would go no further than to say that there's some anecdotal evidence that happens in certain places. Where the political psychology of people manifested itself, say, in consumer behavior the strongest was like during COVID, where people on the right side of the aisle were more cavalier about, lockdown and not afraid to walk into a restaurant. And the people on the left were, I would say, more conservative. And we did see that show up, say, in, a store in a red area was performing differently than a store in a blue area. One thing we wrote a paper on in relatively early 2020 was how that sort of played out in between Lowe's and Home Depot. Lowe's tends to be in more red areas. Home Depot tends to be in more blue areas. And we just saw different returns to foot traffic in those stores for that reason. So I would say there's some anecdotal evidence, but it's not enough to really dramatically move the overall economy because they kind of balance themselves out, right? We are a bifurcated group of people along party lines for the most part. And so if one group does tend to spend down a little bit, the other one lifts it back up and it sort of averages itself out.
That's super fascinating data, John. Thank you so much for that. Mm-hmm. We are going to take a break. We are going to do our best at providing some reflections on the top economic stories of 2023 and perhaps even some predictions of what's to come in 2024 right after the break.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at pentagrp, or find us on LinkedIn at Penta Group.
Welcome back to the Macrocast. It is that time at the end of every year when we reflect on the biggest economic moments of 2023 and make our predictions for the year ahead. I know that we talk about the Fed almost ad nauseum on this podcast, but I gotta say, it seems like the Fed, both in terms of the peak and what looks like now the pivot, has gotta rank up, if not the top story, very near the top.
Yeah, absolutely. And coming into this year, that was, 2022 was a real tough year for financial markets with the incredibly steep, historically steep tightening cycle that the Fed and a lot of other central banks around the world had undertaken to battle back inflation. And coming into 2023, our view was that we would be entering in the first part of the year kind of an eye of the storm, so to speak. You'd be getting that moderation of inflation. Growth would still be okay. We, maybe slowing down a little bit as the tightening took hold and fed through. but no smoking gun for a recession. And, the early part of 2023 would be dominated to such a great extent by guessing games about when's the Fed going to stop hiking? Where's the peak? Are we almost there? And we thought that would be a pleasant time for the markets, a sort of, as we said, sort of an eye of the storm. But we thought that ultimately growth would begin to show a lot more downside than it did. And create, a lot more growth scare kind of dynamics in the back half, middle to the back half of this year. And that really was proven very, very incorrect. The U.S. economy, I think, surprised a lot of people by soldiering on with the consumer that we've talked about before. Shouldering so much of the burden, despite the headwinds that had built throughout the year, and so coming into the middle of the year, the Federal Reserve wasn't slowing down its tightening because growth was really looking bad, and the balance of inflation and growth risks were getting closer. It was almost entirely because inflation was slowing. And that was a truly favorable dynamic. And coming into the end of the year, as you alluded to, Ylan, the idea that higher for longer was going to be with us, and that was going to be the theme of the Fed into 2024. Well, that's been proven wrong as well. And the Fed is now, despite some rhetorical rearguard action, I guess, a little bit of cleanup by New York Fed President Williams, Atlanta Fed President Bostic, and some of the others who are kind of coming in and saying, don't get too excited about rate cuts. But, the cat's out of the bag. It's going to be really hard for the Fed to take that back. They are definitely they're talking about cutting rates and talking about cutting rates, and pretty soon they're going to be cutting rates, and that inoculates markets against growth fears going into next year. So it's a lot brighter outcome than I think we and a lot of other people expected.
Yeah, Greg Ip wrote a really interesting article this week saying everyone thought coming out of the pandemic we were going to have this completely new economy with really high inflation, low growth. The Fed was going to have to do all these crazy things, and he said what's kind of proven the case is we're just back to the economy we had. We're in a low inflation environment with 2 to 3% growth, and really there's not how much the Fed can do about it. Really, the Fed did raise rates, but the reality is that inflation is coming down because the supply chain disruptions and our spending behavior disruptions, normalized, and we're back to where we were. And the Fed is going to, normalize back to where we were, and we're going to move on with life.
And one of the things that was really interesting, and this was something that was raised when we were preparing for this, was the Silicon Valley Bank collapse. That was a huge. The idea is that when the Fed is hiking rates at such a breakneck pace, that is going to cause some crashes, right? And it's going to really take down some, whether, the old Warren Buffett, the tide going out, and there are plenty of people probably swimming naked, or whatever, analogy you want to use. Silicon Valley Bank was, relatively isolated, although it was a big scare at the time. It was something that, put, I think, a lot of people on notice that, wow, tightening really is beginning to feed through. And then it, with a combination of, sort of Fed messaging and, the regulatory approach and, the private sector to some extent, kind of playing ball here. They managed to stop that domino effect from getting any worse. And, banks haven't been in terrific shape this year, but we haven't seen like a complete collapse in credit. It's ultimately, when you look back on it, it has been, a impact on the bank's profitability, but hasn't really shaken the foundations beyond this kind of, it ended up being an isolated incident. And that was certainly not necessarily, something you could have predicted at the time. It looked like there were some real spillovers that could potentially happen.
And Brendan, something you said just sort of jogged a thought, which is, you said we're coming back to a normal economy. And I just think back to the, depths of the pandemic and so many of us questioning and wondering, are we ever going to get back to normal, or is there a permanent change that we're going to see in our economy, in our society, in our lives? And I really feel like this is the year where we kind of forgot about all of that, and life did really feel normal again. I was at Target the other day doing my Christmas shopping, and people are like, pushing up on me in the checkout line. No one's standing 6 feet anymore away from each other, right? And there you have thousands of people who are showing up at Taylor Swift concerts, across the country, across the world. So folks are still willing to gather, to spend money to do so, and willing to be together in a way that we weren't ever sure that would come back when we were in the darkest days. And
that's kind of my prediction for 2024 in terms of office. I think people are going to start to come back to the office much quicker than we realize. For a host of reasons. I think a lot of people are lonely. Like, you haven't seen anybody in 3 years, and you'd like to. But also, I think for the younger people, you're realizing that the young people that are actually in the office are starting to get promotions, and you who are working from home are staying in the same job. So I think that the fears that we're always going to be out of the office, I think 2024 is going to prove that wrong.
We have two. I just had a webinar on Tuesday with our 2024 predictions. So a couple of and that touches on one of them, Brendan. Two things that, and I touched on just some of the spending category stuff that we see probably, which is just maybe shorter term, but two things we expect to start to come back to like kind of a previous normal. One is we anticipate a kind of a renewed focus on like physical health, like health and wellness with the consumer. Really interesting this year. We asked questions in our tracking survey about one of them is, do you view shopping as a form of self-care? Right. Retail. The percentage of Americans who say yes reached its highest point in all the time we've tracked it in sort of like the third quarter of this year of like, yes,
100%.
Shopping is retail therapy. And the percentage of people who view exercise as a form of self-care declined at that same rate. It was sort of like, really, part of it will be because there's this conflation between our economic health and our mental and physical health as well. And I do believe that partly as younger consumers and those who've spent too much this year kind of go into next year and try to turn over new leaves. We're going to see, probably a preponderance of new New Year's resolutions around this is like, I'm going to just kind of try to get healthy again. So we see that as something that will kind of reemerge next year, kind of somewhat related. And this has interesting market implications, not maybe macro market, but people have really like kind of cooled on their like streaming platform spending. The average number of streaming services that the percentage of Americans who have 4 or more streaming services is actually in decline. They're sort of being a lot more scrutinizing of where and how they're spending that money. We're seeing people move more toward like ad-supported versions of streaming platforms. And part of that is to save some money for sure. But part of it is that like, they're just not locked in their house, right? That was a reverberation of I'm home all day, not going out into public. So like, I want to have every television show and movie at my disposal and I'm willing to pay anything for it. That seems to have kind of like reached a new equilibrium. So all that just points to a consumer that's going to be out of their house more, not just like hiking and things like that we saw in 2021, but just like reintroducing themselves into society. And I think you're right, Brendan. I think some, an uptick in sort of return to work is going to be part of that story as well next year.
Yeah, I live by a bunch of colleges, and these kids are, in their workout gear. They got their smoothies and water bottles. I don't remember in the entire 4 years that I went to college drinking water once.
Not even after the longest night at the bar, Brendan.
Yeah. Well, then
Miller Lite was
Gatorade, but not
Miller Lite was as close as you got.
What about when the ice melted in my Jack Daniels? Does that count?
Yes, very healthy, and some not drinking at all, right? I mean, that's another trend. I mean, I'm speaking like the old lady that I am now. Like the kids right now, they're not drinking alcohol anymore. They're drinking mocktails.
That is very, very true. Alcohol consumption among this younger generation is, I don't even know these people. But yeah. And again, I'll mention Ozempic again. we have a Ozempic tracking product that we put out looking at sort of its implications on different kind of spending categories. And nobody has called us more about that than beer and alcohol companies in the last like 3 or 4 months. And they have, there is significant now academic evidence that Ozempic usage for weight loss is also impacting alcohol consumption. It's very, very real.
Wait, can you not drink if you're taking Ozempic?
No, you can. It's just that it kind of seems to sort of rewire your brain a little bit in that you just kind of a lot of sort of addictive, compulsive kind of behaviors are just lessened among people on the drug. Like that's the thing. It's not, you're seeing, early signs of like less snacking. The big question with Ozempic that we are paying very close attention to is, do people stick with it? Do they and do they stick with it? And if they stop taking it, do they gain all the weight back again? And just like a lot of fads that we've seen, this one feels, and not just feels, but the early data seems to suggest it's very different. If people stick with it and the behaviors that seem to be change for the long term, there are all kinds of economic implications for that across retail categories, food categories, medical devices like CPAP machines, things like that, knee replacement surgeries. So there's still a chance the whole thing's overblown and it turns out to be a fad and everybody does it for a while and stops. But if it sticks for a while and then insurance companies start covering it, it's a huge, huge, huge economic story.
All right. So we can just put aside the evolution of AI and talk about the evolution of the human body as the top prediction for 2024 and all the ways that will have economic and social ramifications. We're calling it. We're calling it here on the Macrocast.
And I hate to veer into this lane, but we are a DC-based podcast. And, if
there's an election next year.
Yeah, if you don't drink, you might want to consider starting ahead of this election cycle, because this is going to be, obviously, as you said, Ylan, something with consequences for social and economic policies. So it's hard to think of an election in our lifetimes that has, more binary outcome in terms of, at least in, the broad brushstrokes. I know we've talked about this on the Macrocast before, that there are, these places of overlap increasingly because of the way that that Trump has changed the Republican Party's DNA to some extent to a more populist kind of approach, which kind of veered into the Democrats' lane. But overall, we're going to be looking at some really, divergent potential outcomes based on what happens at the ballot box in November. And, not to get too political about it, but, typically the market, Wall Street, to personify Wall Street, would see, a Biden second term with, the Democrats keeping the Senate and retaking the House as, less of a positive than the other outcomes because of, the regulatory approach and that sort of stuff, the sort of reflexive preference for Republican, low tax cuts, that kind of thing. You're not going to get that under a second Biden term. But, at the same time, the Biden administration has kind of fired all its big, fiscal guns for the second term. It's going to be kind of stay the course with the big, Inflation Reduction Act and bipartisan infrastructure bills. The China stuff, I think, is probably on a relatively steady course under the Biden administration. They're probably going to focus on some of this more like soft stuff, like elections and election integrity and social issues and abortion and all of these things that are going to be a big part of the campaign, and maybe economics. They're going to try to tout what they've accomplished, but maybe not put a whole lot of economics on the agenda. The Trump administration, 2.0, who knows exactly what it would look like in sort of the broad panoply of policies. But on the economic side, he's made it pretty clear, that he sees interest rates as too high and he wants to cut taxes again. And, that is something that in most circumstances, Wall Street would fall all over themselves to be happy about. But, it is a different context. And I think that's one of the things that we've been thinking about is, the extent to which a big like reflationary Trump, if it is true that the US is going right back into sort of like a low inflation environment, then maybe that's fine. But we all saw what happened to Liz Truss in the UK when she came out with a big, some would argue sort of fiscally irresponsible package, and the UK gilts market just like rejected it, and she ended up getting turfed out of office. And so there's question marks around what would traditionally be something that's very attractive in terms of policy for Wall Street. Maybe there are some issues and some constraints that the bond vigilantes might put on Trump's most reflationary kind of policy choices.
Well, one prediction that I think we can all agree on is that it's going to be a wild ride in 2024. And we hope that everyone will keep listening throughout the year and stay with us on the Macrocast. That does it for us for 2023. This is our last episode of the year. And I do want to end by taking a moment to say a huge, giant, enormous thank you to the very dedicated team that helps us produce and promote this podcast every single week. I'm going to call them out here so that they get the recognition that they deserve. And the folks include Bob Dewey from Markets Policy Partners, Claude Jennings Jr. and Cleavon Davis, our audio engineers and producers. Shout out to my colleagues at Penta, including Brian DeAngelis, Will Newell, Lizzie Johnson, Julia Desarega, Ali Batal, Aparna Iyer, Brooke Van Horn, Emma Sunken, and Meredith McCleary. Thank you, of course, to John and Brendan for joining me for this ride every single week. We appreciate John Dick for his regular appearances and very smart insights. And of course, we appreciate all of you, our listeners, and we hope that everyone has a wonderful holiday and a very happy new year. Thanks for listening.